Warren Buffett and private equity firms are both buying insurance companies. Here's why they want the same asset for opposite reasons. Berkshire Hathaway just spent 9 months quietly buying $7 billion in Chubb stock. Buffett's been in the insurance business for 57 years. His float has grown from $17 million to $83 billion. Meanwhile, private equity firms now own 137 U.S. insurers. Apollo bought Athene for $11 billion. They're all chasing the same thing, insurance float, but they're using it in completely different ways. And that difference matters for how markets work. So here's what float is. When you pay an insurance premium, the company holds that money until they have to pay a claim. That gap can be months or years. During that time, the insurer invests it. That's float. It's essentially a loan from policyholders that you don't have to pay interest on. Buffett's used Berkshire's float to buy stocks like Apple and Coca-Cola. He's patient. He holds forever. Private equity uses float differently. They lever it up. They deploy into illiquid credit strategies like high-yield debt or structured products. The goal is maximizing short-term returns to generate fees. Buffett builds permanent capital. Private equity extracts yield. Both work, but they create different systemic risks. When insurers invest conservatively in bonds, the financial system stays stable. When they chase yield in private credit or leveraged strategies, correlation risk goes up when the business cycle turns. If markets freeze, insurers holding illiquid assets can't meet claims. That's the trade-off. More yield today, more systemic risk tomorrow. At Lumida, we track where institutional capital flows. Insurance flow is one of the biggest pools of capital in markets. How it gets deployed matters. If you want to understand where markets and private opportunities are heading, not where they've been, join the Lumida Ledger. It's a newsletter designed for people who think forward. Check the link in the bio.